While everyone panics about government shutdowns and tariff threats, the market quietly delivered something far more revealing. Monday's rally wasn't random. It exposed a critical psychological shift that most traders completely missed. The crowd sees chaos, but the discipline sees exploitable patterns. Here's what separates profitable traders from the noise-chasing majority. Last week, while headlines screamed about political theater and Fed uncertainty, something fascinating happened beneath the surface. The SPX gained 0.5% Monday, the Dow climbed over 300 points, and gold simultaneously broke above $5,100 per ounce. Most people see contradiction. The stoic exploiter sees human nature operating exactly as designed. This is the market pricing two futures simultaneously, and it's completely predictable when you understand the psychology driving it. Let me show you exactly what's happening and why this creates opportunity for those who think systematically rather than emotionally. The human layer reveals everything. Participants entered this week suspended between anticipatory positioning and defensive hedging. They front-ran megacap earnings in Apple, Meta, and Microsoft while rotating into gold as insurance. This isn't confusion, it's cognitive dissonance in action. Experienced money recognizes volatility as baseline, not exception. They're not betting on outcomes anymore. They're hedging probabilities. Notice what didn't happen. Tariff threats and shutdown fears didn't trigger panic selling. Instead, they induced controlled vigilance. The Monday rally wasn't euphoric but methodical, institutional rebalancing ahead of Fed decisions and earnings concentration. This behavioral shift from directional conviction to scenario planning is exploitable because it creates predictable flow patterns. The flight to gold signals deep mistrust in policy coherence, while simultaneous equity bids reflect faith in corporate execution despite macro noise. Humans consistently compartmentalize risk this way. They can hold contradictory truths when uncertainty peaks, and the market rewards those who recognize this duality rather than fight it. Now, the system layer shows how these behaviors create opportunity. The market absorbed conflicting inputs with minimal structural disruption. Durable goods orders jumped over 5%, providing evidence of real economic activity beneath surface volatility. This data point anchored equity buyers and prevented broader risk-off cascades. The technical structure confirms this. The SPX held above its October support zone near 6830, with Monday's move above 6900 signaling continuation rather than reversal. Volume patterns suggest institutional accumulation, not retail speculation. The dollar's weakness and gold's strength aren't contradictory. They're complementary flows away from policy certainty toward either growth narratives or hard asset insurance. Sector rotation favored technology and communication while punishing consumer discretionary. This selectivity indicates the system isn't breaking but fragmenting into micro-regimes where different assets respond to different drivers simultaneously. History shows this fragmentation consistently precedes either major breakouts or significant corrections. The Fed's anticipated pause Wednesday is already embedded in pricing. Markets discount 2 cuts by year-end, a dovish tilt supporting risk assets while pressuring long-duration bonds. This is systematic behavior, not random noise. Here's the stoic approach. The market functions as designed, pricing uncertainty while rewarding patience and punishing emotional reactivity. Volatility isn't a bug, it's a feature of a system navigating fiscal instability and earnings concentration. The crowd's fear of shutdown and tariffs created opportunity for those who recognized these as known unknowns already discounted. The Monday rally wasn't trend reversal but process reversion. Participants who positioned defensively into prior week's weakness were rewarded for discipline. The gold breakout confirms system bifurcation between those who trust institutions and those who don't. Both can be correct in different time frames. What matters isn't Fed policy, but whether Apple, Meta, Microsoft, and Tesla validate the premiums embedded in their multiples. The durable goods data provided evidence the real economy isn't collapsing, sufficient to sustain equity bids absent systemic shocks. The disciplined participant doesn't predict but adapts, positioning for multiple outcomes while maintaining flexibility to pivot as information arrives. The week ahead tests whether corporate execution can override political noise, a test markets pass repeatedly but never permanently. This is exploitable because human psychology creates recurring patterns in systematic market responses. The crowd reacts emotionally to headlines while missing the underlying behavioral shifts that drive actual price movement. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability rather than chase market randomness. The complete Stoic Exploiter methodology is available in the description. Download it if you're ready to trade psychology, not headlines.